Fearless Disease.
Let's kick this week off, Joe. You're going to get data, which is front and center, and the rotation trade is in full effect. Take a look at market performance over 1 week. We're going to show you sectors to give you an exact picture of what's been happening within this market. Materials up 4%, financials up 3%, industrials up 1.5%. Cyclical plays. What's down? The bottom of the list, communication services and technology. So that's how we begin this week. Deutsche Bank says tech saw its first back-to-back weekly outflows since June. We have this rotation trade going to continue?
Right place to start the conversation.
Thank you.
I think this is going to continue as we go into 2026. I think from a bigger picture perspective, thinking about the broadening out and the opportunity outside of just the Mag 7 and the AI adjacent technology names is real. I think you carry that into 2026. There has been a meaningful rotation. It started with the momentum factor kind of rolling over, and now it's really more isolated to technology and AI itself. I think in the near term, there is going to be a little bit of a return to some of the Mag 7 names, some of the technology names, just in terms of the performance differential between the 493 and the 7. It has gotten pretty wide. I think this morning we had a meaningful flush lower. I wouldn't be surprised to see a little bit this week if you see the Mag 7 come back, if you see some of these technology names come back and narrow that price differential. But bigger picture, I like where you're going with that. I think the rotation's real.
FearlessDisease fam, today we expose the truth they hate to hear. Like right now, if you are ready, as you see, we're already talking about the technology stocks right now. If you're into trading, the S&P right now is slightly lower at 68.1651. I saw you saw is a little bit different. I'm talking about as far as right now as we speak on Tuesday morning, we're down about 0.59% as AI trades pressure hits. Key stocks are basically under fire right now. They're going down. Of course, it's the end of the year. They go down just a little bit towards the end of the year because everybody's buying for, or some people are even saving money. And it's going to be a little bit of inflation up and down when it comes to the holiday season. But I think it'll kick back up during Q1. But let's hear what else this young gentleman has to say.
You're going to get always, nibbling and dip buying in that group, but the so-called run it hot trade, that's what remains in focus as people prep for 26. Is that something to run with for the foreseeable future?
I think so, and I think there's a couple of things here. Number one, we still have this transmission of lower interest rates, regardless of whether you think they're going to do 1 or 3, depending on what happens in May of 26 with the Fed chair. I think that you get that as a tailwind. The other thing is, Scott, we saw the Fed increase their expectations for economic growth next year, and that run it hot trade is based on the fact that you are anticipating an inflection higher and a reacceleration in everything from manufacturing and construction to consumer spending, and this liquidity infusion that we're due in April and May around tax time. All of these things really are supportive of the fact that if you're looking at just the fundamentals and why equities go up over time, it's earnings growth, and earnings growth is expected to be strong up and down the U.S. cap next year. And so to Joe's point, we may see this delta between the Mag 7 and the rest of the 493 narrow at certain points. But I think in terms of where we are, we're seeing a channel where earnings growth is going up and to the right, and the bottom part of that channel is continuing to rise as a result of the more attractive valuations and the anticipated earnings growth next year on economic tailwind.
Some are wondering why.
She's very right. She's true about that. About the economic tailwind is going to happen, especially at the beginning of the year in Q1. It's just right now. It's just gaining some horsepower right now. It's hitting that little dip. It's going to take a little pullback as far as the Nasdaq, the S&P 500, US 30. It's going just a little bit of dip during the holiday season. That's normal. There's not a lot of fluctuation, but as soon as Q1 hit, going into Q2, it's gonna skyrocket right back up. Well, not skyrocket, but it's gonna buy back and grow back from everything that happened over the holiday season.
The casualty of all this, if you want to say that, will be new highs for the S&P. Like, you got your new high, and then you had a Fed meeting, and then the run it hot trade seems to be the outcome of what happened there. Wolf says so much for a return to new highs. Was starting to look like new highs before year end were inevitable. It's now becoming evident that AI euphoria is starting to fade into the end of the year. We think there's a good chance that trend persists into Q1, which likely does not bode well for tech. We don't necessarily have to have a conversation about tech specifically here, but the other idea, run it hot, buy what's hot. Shan hit it. It's consumer discretionary. Hits a new high today for the first time since September. Restaurants, retail, Marriott got an upgrade. Financials have hit a new record high. Those are the kind of stocks that are getting a lot of ink today.
They are, as the market looks for laggards. I've been embedded in this technology trade for so long, and it's always served me well with this V-shaped recovery off to new highs, and that's not really happening. And when you take a look at what the Amazons and the Metas have done in the year, they've really lagged. So new money's looking for places to go that's unloved, and that's consumer discretionary. I personally wouldn't stay in that trade too long because I don't think the consumer's bifurcated, right? There's the real, those that don't worry about the economy every day that keep spending, so that's probably good for luxury, except on the margin, some that reach for that class won't be reaching for it anymore. And then there's, those that are really worrying about their jobs as you get more and more layoff announcements. So I do think that the bull market will continue. I think now, we're just not, I'd be surprised if we saw a strong rally into year end.
Well, I mean, if you look at some...
No, that's very true. Holding long term right now is not a good thing for the big swing traders right now. If you're a day trader or intraday trader, it is perfect for you because. But I think as far as predictions as S&P goes, I think it's gonna really by Wednesday it's gonna test those 67 lows, really test it, and then really shoot up a little bit, so you'll be able to catch your little quick intradays and scalper trades throughout the day. It's going to be easy. Watch jobs data for Fed clues. That's a big tip. That's what I usually do. But pretty simple, straightforward. Stay focused. Smash the like, tap the next video on the screen right here, subscribe, hit the bell. CashApp, FearlessDisease is always in the description if you are rocking with the movement. All right, I'll see you on the next one. Stay rich and stay fearless.